Hey everyone, what's going on? Tonight, I wanted to talk about an investment that I'd made in 2020 in Alibaba. Now, this one it captured the imagination of FinTwit in 2021, I believe, when Charlie Munger, through his company, the Daily Journal Corporation, announced a decent stake in Alibaba after DJ Co hadn't made an investment since the bottom of the financial crisis when they bought a number of money center banks, which was all pretty interesting. I think a lot of people were captured by the Chinese sort of economic story in the first half of the pandemic. It was, you had all the tailwinds of the pre-COVID era. You still had the thematic of, China becoming a more dominant economic and military power, and they had appeared to have dealt, pretty well with COVID-19 to begin with. And, as time has passed, their ham-fisted tactics and the real motivations of the central government there have become pretty clear. So yeah, it's kind of like a way for me to, analyze a car crash or something like that. Certainly when I'd invested in the company in sort of early to mid 2020, it seemed like an opportune time to take advantage of the tremendous economic success that China had been. It's probably a bit of an open question as to whether they can really return to some form of normality. There's a lot of tremendous number of factors at play. Factors that affect the central government's ability to maintain control, and in the in that kind of context, they're going to make very aggressive, authoritarian, ham-fisted attempts to cling to authority, and the economic prosperity of the country, will be something that suffers in the meantime. Now, many of those things are red flags that I've learned to recognize. But it was an interesting episode on FinTwit and Reddit, things like that. How it really captured the imagination of so many people, and the kind of lemming-like behavior behind Charlie Munger and the likes of Monish Pabrai and many others. I believe Rob Vinell at RV Capital, some of the larger growth, well-known growth funds, quality growth funds, also participated in this one. But it's kind of the story of declining business quality, not really understanding, not appreciating the economic characteristics of a place like China itself, perhaps not understanding the politics as well, as people could have in the West, where we're very accustomed to we're very accustomed to the government broadly pursuing policies that engender economic well-being over time, periods where difficult decisions need to be made. But typically speaking, people always, the trajectory is up and to the right, and more goods delivered to the average consumer via a market economy. I don't think people really appreciated how dire the situation could be in China, and the lengths that the central government would go to pursue their own goals first. And then the incredible things we're seeing there with the property bubble, the lockdowns. I think people are getting welded back into their rooms again. I think it's going to be a famine year in mainland China. Obviously, the energy and fertilizer crises will come to bear in a very big way. But putting that aside, this is kind of like my second lesson in illusory business quality. I'll get stuck into what happened to them and characteristics of the business and many of the red flags that people like myself ignored prior to investing in this company. And I don't necessarily think China is like a complete red flag, it's uninvestable, that kind of thing. I think this is an example of a company whose business quality is declining, perhaps has been declining for some time. And it's an example of a company that operates in a country where the relationship with the government is much more important than we would be used to in a Western country. All right, jumping into this. So the history of Alibaba is pretty well known. It was founded by Jack Ma and 17 quote-unquote friends in 1999. Started as a B2B marketplace, place for businesses to sell their products to other businesses. I believe the first iteration of the Alibaba website was almost like a business directory, like a yellow pages of the internet. However, later on that year, the charismatic founder, CEO, chairman, Jack Ma, raised a $25 million investment from SoftBank and Goldman Sachs, which was led by the famous Masayoshi Son. Now, that investment's like one of the all-time great seed investments, I suppose you could call it, venture investments. It's a $25 million investment that has gone on to be worth like billions and billions of dollars. It's a tremendous soul read on the ability of Jack Ma to develop that business. Its sort of 20+ year history has been pretty fascinating. Without getting too deep into the weeds about all the different things, there was a time when US companies would compete in e-commerce in China. eBay and Amazon were early entrants into the market. The mind of the Chinese consumer is certainly a lot different from what it is from the Western consumer, which was probably why Western companies were not successful in replicating their own models there. There's probably a very large degree where the Chinese government and regional and local governments were very keen on having national champions, homegrown champions dominate their own market, having a foreign company have a large amount of control over the country's supply chain and e-commerce environment. I don't think that would have really panned out at all. And this is, and we'll get into this a bit later, but this is a country where the acquiescence or approval of the government is paramount in being successful and even surviving over time. So basically the main properties for Alibaba within China itself, and it runs a number of e-commerce platforms outside of China, and it has venture investments in all kinds of e-commerce companies in Southeast Asia and all over the planet. But the main money makers for it are Taobao and Tmall, which are like auctions and high-end commerce sites. They're not, if you've ever used them before, they're super weird. Like they're really gamified, and there's all these funny, like, cute Chinese characters all over the place, and they're like e-commerce sites are completely chaotic. It's really kind of difficult to figure out what's going on, but the profile of the e-commerce sites don't really follow anything in the West. So through the whole chain of Alibaba's e-commerce sites, you can essentially run an entire commerce business on the internet. You can get everything from raw materials, like cars, bits and pieces, pallet jacks, like anything you could ever think of, you could get it on Alibaba, and you could arrange third parties to deliver it, and you could put it together, and then you could resell finished products on some of their other sites. So it's significantly different from what we're used to. Certainly what I'm used to in terms of e-commerce. So that's kind of like perhaps one of the first things that people didn't realize about Alibaba is there's a lot of difference in terms of its digital offerings. Now, primarily, and they have made a change in this recently, which is perhaps one of the reasons why their financial profile is deteriorating. But originally these Alibaba platforms, so Tmall, Taobao, a couple others, Alimay, not sure how to pronounce some of them, but they're primarily digital networks. So these are properties where people could go and buy and sell goods. But Alibaba was not originally following a model with like Amazon pursued in the United States, where they do fulfillment and logistics, and so Alibaba doesn't enjoy the and it's made significant investments in its logistics network over time, and it's moving more towards that kind of asset heavy model. But it doesn't enjoy the kind of logistics and fulfillment moat that Amazon would. And building that out over China would be, kind of a mind-bending thing. The geography of China is significantly different from other large countries in Europe or the United States, where most of the population is concentrated on its coast, and the internal parts of China are characterized by really rugged, almost untraversable terrain. So this isn't a place like the United States where you've got a relatively easy traversable country with really navigable rivers that run all through it. It's a well-connected country that lends itself to efficient logistics over a very large population. Those dynamics don't play out in China, and so Alibaba's strategy with its e-commerce platforms was to always partner with third parties, and not being vertically integrated in that way has its own challenges. Initially, it's that's how every e-commerce site starts off. They obviously, if you're starting an e-commerce site, you can't without proper funding, or in the case of some of the self-funding. In terms of Alibaba, you can't really build out a logistics network from day one. It's something that needs to be done after you reach sufficient scale and you're profitable enough, and management thinks that it's going to be worthwhile, and it's probably only worthwhile at a tremendous amount of scale, and in a geographical kind of setting that makes sense. So they are, probably fall into the flimsier category of networks in that primarily mostly digital. There's a payments aspect to this that we'll get onto, but that's the characteristics of their e-commerce properties. Now, like I said, they've made investments into their logistics network in mainland China, but it faces challenges, and it decreases the financial profile of the quality of the metrics, basically. So in 2005, they received a pretty large investment from Yahoo, who took up I believe it was a quarter stake in the variable interest entity. So that was also a subject that got plenty of play in 2021, where there was a lot of speculation as to Chinese companies listed in the United States as to whether the legal structure that allowed foreign investors to, in quote unquote, invest into the company was going to be held up, and whether it really, even conferred any rights to investors in the West at all, and to some of these companies. We won't get into the variable interest entity itself because it's quite complicated, but essentially it's illegal for companies registered in mainland China to have foreign investors within them. So the way that they get around this is a legal mechanism called a variable interest entity, which is, I believe it's, so there's the shares owned of a company in mainland China. There's a holding company in Hong Kong that owns shares within the mainland listed company. And then there is like a shell company set up in somewhere like the Cayman Islands that owns this variable interest in the company that owns another interest in the mainland company. And so the legal mechanism there is that the foreign investors own an economic interest in the company's earning power, but not necessarily an explicit equity stake within the company itself, which is all, a bunch of legal jargon. There's been plenty of speculation on whether that's, what kind of rights you actually have. If that's even worth anything. Are they ever going to let any of the capital get out of China so that the shareholders can have capital returned to them? And a lot of that's still up in the air. The way that it's basically ended is the government, the central government in China basically made a statement saying that they were going to respect the variable interest entity. And the reason why they're going to do that is because it's a way for foreign investors to fund continued growth in China while allowing some of these companies to raise capital in deeper capital markets, and for some of their shareholders to offload some of their equity. And so it's still in this kind of grey zone where the government's going to turn a blind eye in the interests of commerce. And so really, for the variable interest entity would be something that goes in the final stages of a kinetic war between China and the West, because it would, there'd be hundreds of billions of equity wiped out in global investment funds, and it would just be a tremendous, kind of nail in the coffin for China, cutting them off from foreign investment. and making basically every financial institution on the planet wary of ever investing there again. It'd be a catastrophic outcome for them, as well as Western investors. And even to this day, China is incredibly reliant on their exports to the West. Anyway, so 2005, Yahoo made this investment, made a large investment. They made plenty of money off this. It ended in a very bizarre way. But we'll come back to that particular event later because it's a tremendous example of corporate wrongdoing later on. So along with the e-commerce platforms that eventually turned out to be profitable, tremendously profitable, they basically were able to spawn two other quite impressive businesses. One was Alipay, which is a payments processor in China. And so if you've ever been there before, basically there's a duopoly between WeChat Pay, or I believe it's pronounced Weixin in China, and Alipay, which is essentially how you pay for anything. There's a lot of QR codes. They kind of they skipped the late 20th century payments innovations in checks and credit cards, and they just basically went straight to mobile payments. And so you pay everything with a QR code, and it's all pretty efficient, and the cost to the consumer is kind of a fraction of what it is. Sorry, the cost to the merchant. Sorry, merchants pay all the processing fees in the West, and in China, that whole payments infrastructure runs so much cheaper for everyone. And the government supported those two mechanisms on that understanding that these wouldn't be really dominant monopolies that ended up taking accruing a lot of profits, which is something they probably observed in the West. Visa and MasterCard, and to a lesser extent PayPal, have made tremendous businesses monopolizing the payment rails. The other business that they started, which got to very impressive scale, was Alibaba Cloud, or Ali Cloud. I won't try to pronounce the Chinese name for that one. And essentially, this is not dissimilar from Microsoft's Azure, Amazon's AWS, or Google's GCP. Infrastructure as a service, and most people would be familiar with what that is. I believe they are the fourth largest provider of cloud services on the planet. For the top players, the cloud business is a tremendous business with a lot of operational leverage, but it's contingent on being what it is, which is a hyperscaler. So the more scale someone can get, hence the name hyperscaler, the better a business that is, due to the inherent operational leverage within it. So being like the fifth or sixth or fourth biggest player is your kind of, you're going to be a very modest business, maybe break even. There's still a lot of questions whether this will be a long-term profitable business for Alibaba, and for reasons we'll get into later, their market opportunity is a lot smaller, perhaps than what people thought it was 5 years ago or so, and no longer enjoys the patronage of the government, which is a significant part of their business. So today, if you ever read their annual report, they basically sprawled into every business you could ever think of. They're in logistics, they're in making movies, all kinds of stuff. And they've got reporting segments which just lose a ton of money, have no idea what they're doing. Not really dissimilar from what happens in some of the more adventurous, profitable tech companies in the West. Too much money, a history of hitting home runs, and executives with pet projects who like to pursue things that may not be very profitable in the long term. Certainly how it has panned out over its history. So like I mentioned, the majority of the cash flow, the net income, and the operating income is basically derived from a small number of these e-commerce platforms that the company runs today. And important to mention that most of that EBIT's coming from mainland China commerce. They've made a number of investments and adventures into Southeast Asia and other markets to compete in their kind of cutthroat e-commerce battles, and they've largely been unsuccessful. And it's kind of even worse because they've been not unsuccessful, but they haven't enjoyed the same kind of growth trajectory as some of their competitors, a la Sea Limited. But it's kind of an open question as to, like, do you even want to win that battle? Because if the logistics problem is a nightmare on the east coast of China and inland China, like what are logistics going to be like when you're trying to deliver like a 50-cent package to a remote island in the Philippines or something like that? So yeah, it's kind of like a galaxy brain type of endeavor where stupidest person wins, and the stupidest person also wins a stupid prize. So like I mentioned before, Jack Ma and the various ventures of Alibaba initially, and there's probably a very I don't think it's a mistake that a Chinese company won this, and certainly somebody like was able to become the dominant player in Chinese e-commerce despite fairly well-funded foreign entrants. A homegrown Chinese with links to the kind of capitalist clique of the CCP. So there's been plenty of allegations over the years that Alibaba probably bribing government officials, etc. The very close relationship between Jack Ma and the Hangzhou clique, I think it's called. It's like a capitalist clique within the CCP, which has kind of been marginalized from power now, probably explains some of the trouble that he's got into. But it's no coincidence that Alibaba's like the dominant cloud provider, payments provider, and e-commerce platform in China. And no doubt there's very talented, gifted people work there, etc. But the relationship with the government, I'm going to say, critically important in a state capitalist system like China. And in the last couple of years, certainly since Xi Jinping has come to power in China, the relationship with the local government officials as well as the central government officials in Beijing has become a lot more adversarial. And we'll talk about the kind of catastrophic series of events that happened in 2021 that has made people have a lot more questions about the kind of trajectory of the company. And so it's important to mention as well that this government headwind, capturing the ire of the government in China is a bona fide headwind, a tremendous headwind. And it's, kind of touch on some of these points, but, becoming an enemy of the US government is not, certainly as a homegrown American company, that there's regulation, there's antitrust, but at the end of the day, the government, really, it's not going to be able to, wreak havoc on large parts of the economy. They can certainly take out very small sectors, but large companies are a stakeholder in Western governments, and they fund all kinds of parts of it, and government realizes that. In China, the policy implications of getting the government on the wrong side can be catastrophic and terminal. So they've had no problem wiping out entire sectors. They have no problem disappearing CEOs. The government can and will fund your rivals. And in recent years, they have made very concerted efforts to decrease the return on equity of private businesses and direct more of the state funding towards state-owned enterprises. So they could just arbitrarily change the tax rates on some of these companies, which looks like that's what's happening. The tax rates going from 15 or 10% to 20 to 30%, significant headwind. And in the case of things like Alibaba, a decent portion of its business is at least tacitly approved and funded by the government. So one of the big headwinds in its cloud business is that it's lost a lot of its government clients, which was depending on who what numbers that you thought were reasonable. It's probably something like 10 to 15% of the business, but it's not losing the approval of the government there. It's a big deal. You'll lose other deals because of that. Other people will leave, and your competitors will win at your loss. One of the things that was started in China even before COVID was the central government and local governments beginning to place government and party officials within companies to make sure that they were complying with party doctrine, and that they weren't going to, the local governments wanted to make sure that these companies were behaving appropriately. Now, adding just doubling your bureaucracy in one go and having party apparatchiks questioning business decisions, a tremendous headwind. Anyone who's worked in a business or run a business, whatever, decisions need to be made pretty quickly, and opportunities in the marketplace need to be seized quickly. Having this, huge layer of bureaucracy stopping you from doing that is awful, terrible. And the controversies that the company can get itself embroiled in, this is not like the West where maybe the CEO is forced to retire with the golden handshake and, he spends the rest of his days at the country club and playing golf. This is like life and death. The CEOs disappear, which is what happened to Jack Ma. And, things like their family can be threatened, and, things like that. This is like a life or death game. This is not, how we operate generally in a part of the world that has Western world rule of law. So that's a little bit of the history, kind of some of the characteristics that the company has at the moment. I'll address the COVID till present day period a little bit later. But there's some interesting things to reflect on in the company's early history. This has been some very high profile corporate shenanigans happen, which again would be an immediate kill for me on an investment idea now. But when you're younger and dumber, you make some of these mistakes. In 2011, so this is where the previous Yahoo investment becomes interesting. In 2011 and into 2012 and several years after that, there was a controversy where Alibaba was still technically, it was not listed on any American exchanges at the time. And Jack Ma had attempted to spin out Alipay into Alibaba, so a dominant payments processing platform in a highly digitized economy. So a key infrastructure payment asset key asset. Very long-lived, very profitable. It'd be like owning Visa or MasterCard, something like that. That kind of level. And Jack Ma had attempted to spin this business off into a separate entity, and it was very unclear about the ownership structure of the company that Alipay was being spun out into. And there was an enormous controversy that went on for many years with Yahoo, as it owned 25% of Alibaba, but its status of what it now owned or what Alibaba owned, this Alipay asset, was unclear. So just trying to worst case scenario, Jack Ma was just basically trying to steal a asset straight out from under a foreign investor, who ironically, the capital raised in 2005 was to fund operating losses in Taobao and Alipay. So a strategic investor who invested specifically to fund losses in these business lines had the now profitable asset almost stolen from them. I think the way this was eventually resolved was that a significant portion of Alipay remained owned by Alibaba. And so the foreign minority investors were able to at least accrue some value from that. So that was like a enormous red flag. The circumstances surrounding the spin-off were a corporate governance nightmare. The board wasn't even informed of this. It was a harebrained scheme by Jack Ma himself, and the original outside investor, SoftBank, was suspiciously, very quiet about this all happening. Look, eventually the Yahoo investment panned out just fine, and it was like a special situation at the end because the Yahoo holding company basically didn't own anything except this quite large stake in Alibaba. So yeah, that was one pretty large red flag in its corporate governance history. If you dig into the company itself, it has this obscure and Byzantine partnership structure that controls that controls the company. Controls a majority stake within the voting rights of the business. And this partnership, it's quite difficult to really get a grasp of what's going on, but the intent seems to be it's a mechanism for Jack Ma and senior management to keep control of the business permanently. And so you can kind of read this as like a the levels of ownership within the company. This isn't like a dual class structure. This is like, I don't know, like a quad class structure, quintuple class structure. And current management basically aren't really responsible to the other minority shareholders. Yeah, pretty much. So it's like the worst example of something like that. And obviously in its past, there's been a long history of supposed government corruption. Right, so I'm going to bounce over to an article I wrote about Alibaba. So admittedly, quality at a great price, and that was halfway through last year. Full disclosure, the stock's down a tremendous amount since then. And we'll kind of discuss, why. So since Xi Jinping has taken control of the government, and then ever since really tightened his grip on China and read the independent centers of power, so the large corporates, Alibaba, Tencent, and what have you, is made a concerted effort as a status. This is a person who is a committed socialist / communist. This is not the fake communists of the past who paid lip service to Mao, but were interested in economic success and prosperity for their country. The current cadre of leaders are committed socialists. And their understanding of that is that the state will support large state-owned enterprises, which will dominate the economy. And that's a way for them to exercise ever greater control over the population. And the real effect of that is that capital generally gets allocated less efficiently. So that the capital gets allocated on non-economic reasons, political reasons, for issues of power, that kind of thing. The pure return calculation is not taken into account. And it's not a good thing for the Chinese economy as a whole. You can have all kinds of tailwinds that you like if the return to capital goes down, all things being equal, your investments won't be very successful. A great example of that is Japan, who have obviously faced all kinds of macro headwinds. But the real gist of why there's been so little movement in the general stock prices since the bust of the 1990s is that the return on equity is remarkably small and capital isn't efficiently returned to shareholders or invested in the most optimal way. So that's a huge headwind for the country as a whole. But having said that, so that's kind of like the run up to COVID. You have this regulatory and economic regime that is hostile to domestic capital and probably completely ambivalent to foreign investors. And so within this tightening economic and political control, you had a number of controversies happen to Alibaba in the end of 2020 and then into 2021. So this was all kicked off by a speech by Jack Ma, who had stepped down as CEO of this at this point and had remained as the chairman, ostensibly pulling the strings from behind the scenes in the Byzantine partnership that I talked about just before. And so he made this like fiery speech in a kind of forum of government bureaucrats in the banking sector. Basically saying that China was being run as a back alley market or something like that. They were parochial and backwards, and didn't weren't forward looking in how they were developing banking, payments, that kind of thing. So this is a complete no-go. In China, you criticize the government and its agencies at your peril. And a number of things happened consequently to this, which were not very good for him. You can see here on Monday, the 2nd of November, he was summoned before the Banking and Insurance Regulatory Commission, where he was dressed down by a number of high-ranking bureaucrats. And the following day, the proposed IPO of Ant Group, known as Alipay, there's a planned domestic IPO for this business, one of the largest IPOs in history, and it was pulled. So this would have been a way for Jack Ma to realize tremendous value on this core asset. And so there were a bunch of reasons for this, aside from his fiery criticism of the banking authorities. One of which is that by this time, the large payment processors had encroached on parts of the lending infrastructure that the Chinese authorities were keen to keep within the state-owned banks. So for some reason, if you begin a successful digital business in mainland China, your next move after you've established your initial successful venture is to begin lending money. And so you can see with an asset like Alipay, which is a digital payments platform run off your mobile phone, if people are using this all day long to pay for things, it's not that hard to overlay a lending facility on top of this, which operates completely outside of the purview of state-owned enterprises. And so the central government's desire to control the flow of capital and prudently, mind you, to make sure consumer lending doesn't get out of control, they would be extremely adverse to this. So this was probably another reason why the IPO was pulled, as a way for them to rein them in and get them out of business lines that they were not interested in Alibaba participating in anymore. And so from basically January 2021, there began to be all these antitrust probes into Alibaba and to a lesser extent the other large tech player, Tencent. And there are all kinds of reasons given for this. You could go onto the Chinese government website and read the panoply of unfair business practices, etc. The bottom line is that there is no such thing as antitrust in China. And there's certainly no such thing as illegal anti-competitive practices. It's basically the Wild West. You can do whatever you want, so long as you have the authorities on side. And this was a mechanism for the government for reining in a independent center of power. And so they've been hit with all kinds of fines. They've had smaller fines since. And from that point, basically the stock went straight down. So it was over $300 in some point in 2020, 2021. And I think as of today, it's less than $90 a share. So even into this point, the business, still performing pretty well. All of its reporting segments were reporting pretty well, but maybe some of the long-term trends in its financial performance were beginning to accelerate in terms of its business quality declining as it kind of chafed under these regulations, their inability to force practices which they had no problem doing in the past. This was things like forcing people who sell on the platform to exclusively sell on the platform. These are business practices that would be so outside of the realms of practice within the West. You wouldn't even think about doing any of these things. It's almost unethical, bad manners. I don't know how to describe it, but these were things that have been stopped many over 100 years ago. And so there were some sensible regulations and reforms that the government and the company did pursue. And so that kind of brings us up to that was kind of the major theme in 2021. These never-ending series of announcements where the government was cracking down on the company, fines were being given, business practice were being stopped, parts of its ecosystem were being opened up to smaller competitors. Now, in the run-up to COVID as well, the ability for operators like Alibaba, especially on the e-commerce side, to continue what was an incredibly dominant position over over 1 billion people, was being somewhat challenged. There were a number of smaller businesses that had made very decent inroads into various parts of the Chinese retail market. So there are the likes of JD.com, and there was another platform. Sorry, the name escapes me. They'd pioneered a form of commerce called group buying, which was communities would band together and purchase their goods and food and groceries and stuff like that en masse, which is very, very different from the Western consumer. But everyone in your apartment building are banding together to buy groceries, at a month at a time, kind of thing. It's kind of like, poor Chinese peasant mentality meets Chinese retailers. In any event, part of that was successful. JD.com pursued a business strategy not dissimilar from Amazon, with their kind of a cheap, quicker, better selection type policies, a more focused e-commerce strategy, as opposed to an Alibaba, which is a bit of like a free-for-all. You can get absolutely anything on there, like forklifts and trucks and stuff like that. And so these players, they had made they had made dents in part of the e-commerce platforms. Not saying they were taking they were necessarily taking away large parts of Alibaba's business, but Alibaba had attempted to compete in some of these verticals, and looks like they had lost. And so that was something that was becoming more pronounced during 2021. Their share of overall e-commerce, reached 50% for the first time, and that's on the way down from about 80% 5 or 6 years ago. Still very good business in terms of the core commerce, what they used to call core commerce in mainland China. Now, obviously, with the really draconian policies that the central and local governments began to pursue at the end of 2021 and continuing into where we are now in 2022, probably the real Chinese economy has been absolutely, the domestic Chinese economy has been nuked in various places. And the housing crisis, in terms of a potential bubble bursting, property developers going out of business, and people not performing on loans where they had made considerable down payments for apartments that never got completed. Those things are obviously a huge headwind for business quality. Investing in places like China, you do need to keep in mind that the economy it can be a basket case. And the reason why it can be a basket case is because, like I said, the government is a fairly narrow interest group. And even though people like to say that the legitimacy of the Communist Party is tied to ever-increasing living standards for the population, you can see that they actually don't give a shit about that. Primarily what they're interested in is remaining in power. And there's no line that they won't cross to achieve that. And so that kind of brings us up to where we are now. So like I mentioned here, in terms of the actual business quality of the company, so really what we're talking about in terms of valuable assets that this company owns is a handful of e-commerce platforms that aggregate a tremendous amount of demand, supply and demand within China itself. So primarily Tmall and Taobao. They own so many of these platforms. Some operate internationally, so some operate in Southeast Asia. Some, there's like a alphabet soup of different ones that operate in China, and there's no doubt that's a really valuable thing. China is not a place that has a traditional retail experience. If you grew up in a Western world country, and you're over the age of like 25, your formative experiences buying things would have been in a brick and mortar type setup. You wouldn't have been accustomed to buying all your goods and services digitally, but in a place like China, they basically saw what the West was doing and in terms of where they were going. And their rapid industrialization and gentrification was coupled with a huge boom in e-commerce. So within the Chinese consumer, a lot of commerce gets done online, as opposed to somewhere like the United States, where still 85% of commerce is done brick and mortar. And so those are incredibly valuable assets. Their ability to continue to grow gross merchandising volume is still there. They probably, online retail will be a place that they encounter competition forever as people try to pick off niche offerings and pick off different verticals, and that's just going to be a mainstay of what they do going forward. The other two assets which would be interesting would be Alipay, of which they own, Ant Financial, which owns Alipay, which they own a third of the stake in. Again, we haven't gotten to a place where they're going to be able to spin that off, so the valuable of that 1/3 stake is a bit like up in the air. It's a bit difficult to really put your finger on. And certainly, that is something that the government might, they could make sure that never goes public if they want. And different things could be jigged around with the ownership in the background. Certainly the value of that company, the value of that stake in terms of the government getting it out of consumer lending and so forth has no doubt decreased the value of that. Consumer lendings are really profitable in China, and putting a lending platform on top of the dominant payments provider, it's a significant amount of value that's been taken away from that asset. And that just ties into this theme of if you get on the wrong side of the government, your business value can be incredibly impaired. The other part that would be interesting is the cloud computing. And so the cloud computing, it's a bit of a, how valuable can this be? It's certainly not worth the multiple that an Azure or an AWS would have. So that was certainly a mistake of mine, thinking that all hyperscalers that had reached some level of scale would have anomalous, would have common economic characteristics, and that's certainly not true. This is the Alibaba Cloud is something that still hasn't reached profitability. It has reached a couple of quarters of positive operating income in, I believe, the last 2 quarters before the last. And in the last quarters, it showed a pretty significant operating loss. And so it faces some insurmountable limiting objects. And so the first one would be is that in any of the developed economies outside of China and the Near East, and certain parts of the Near East, having a cloud computing provider in China would be a complete and utter no-go. Obviously, if you're a American company, of any scale, there'll be tremendous pressure on you to get off it, which is what several players did in 2021. People who are using Alibaba Cloud services stopped using it because it's a national security problem, something which hasn't been realized in TikTok yet. However, so their opportunity is basically limited to China and those parts of the world which remain friendly to China, which are small number of countries in Asia, in Southeast Asia, nothing of any consequence. Certainly, I don't think the Russians are going to be interested in their cloud computing being powered by China. Maybe Iran and Pakistan are interested, not sure. So it's largely a Chinese domestic opportunity. That's not necessarily a problem. The Chinese economy will be, a big economy for many years to come. The difference is that they do not have the kind of diversity in web services that the West has. The West has a tremendous ecosystem of different software and internet players, which has been, an enormous place for value creation over the last 20 years. The Chinese software landscape is also dynamic, not as dynamic as all the offerings in the West, though. The other problem that they will face is antagonism of the government, which was 10-15% of their business, which essentially just got wiped out in one go. this is a segment where if you don't have the government's blessing, it's definitely a headwind, and people like Tencent and Baidu will come and take that business, and probably new business coming forward. I've read several reports that their engineering talent is quite mediocre. So that's a general statement. I'm not talking about individuals. But it seems like in terms of innovative products, probably not on the same level as a ByteDance. Not even close. So the cloud computing is certainly worth a fraction of the multiple that an AWS or an Azure would be worth, and there's a question over whether it will be long-term profitable. The nature of being a hyperscaler is to get to tremendous scale, so you can flex the operating leverage, and so they might never get to that kind of level if their opportunities just going to be limited to mainland China, that's going to face all these problems going forward. Right, the original business setup within Alibaba. Come on. So running these very light marketplaces is undoubtedly it's a capital light business. There's certainly no doubt about that, and you can have a kind of a very healthy cash conversion cycle where you get the money up front, hold on to that money for some period of time, and then once the goods and services have been exchanged, then the money gets sent to the merchants, less to your cut. And so one of the things about the Alibaba marketplaces is that their take rate in terms of the GMV that they process has been really low. So it's like a fraction of what an Amazon would charge. And so there's been speculation over the years as to there'd be tremendous operating leverage when they started upping the rates that they were charging to their merchants, and it's come up somewhat. Again, you kind of get back to the same characteristics that they have with their payments business, where they're sort of a prisoner of these low rates. They have the implicit blessing of the government, or at least since recently, because they're able to facilitate a tremendous amount of commerce at a very low cost. And this is one of the reasons why WeChat Pay and Alipay were de facto given a dominant position within the payments infrastructure, in that they are purposely not harvesting all the economic value that they could. And so that they probably never will achieve a take rate that they'd be able to achieve in the West, and all that is a lost economic opportunity for the shareholders. Even though it is still a decently profitable business with much really decent margins, but those are coming down over time. So you can kind of see how, as the business has grown, and there's a few different things going on in this chart, but the blue is revenues and the orange is free cash flow. Has been very, very good growth over the years. And coming off a small base and running, these very asset light businesses that are generating most of the revenue and operating income and cash flow, is that when this business first went public, it had a very different economic profile than it has now. So I might even be able to pull this back a few years. Yeah, right. So in terms of gross margins, we've got the black line here. So the gross margins, back when they went public, in the 70% range, which is enormous, and decently profitable business. This is a quarterly reading, so typically a commerce business will generate most of their profit in the holiday and large buying seasons, which I think are a little bit different in China than they are in the West. However, you have this dynamic where the gross margins are declining over time. So gross margins have roughly halved since this company has gone public. And another point you probably want to mention is that this is the reported numbers of the company, and you have no idea whether they're just making all this up. Probably not, but you never really know. You probably can't be confident with the exact numbers. But the gross margins have been declining over time. And that's as more competition's entered the space. They've entered lower return business lines. They're doing things like logistics, movies, you name it. They've entered into these lower and lower return business lines, which admittedly do generate some revenue. So you have something like the cloud computing segment, which has been growing very, very fast, but generating modest operating losses almost every year. And so that's something that you don't like to see in an investment. A business that is organically growing volumes, but also flexing a lot of operating leverage over time is basically, what you'd like to see. Revenues and volumes going up, and that generated, that return being generated off a modest tangible asset base. It's kind of like the exact opposite. You've had a lot of growth in the tangible book value. So you can see here the book value of the company has increased dramatically over time. And the margins have gone down, and the cash flow, the free cash flow margins have also, been deteriorating. So the company, on the revenue that it does make, makes less free cash flow, and is in fact, kind of flexing, deteriorating losses during the weaker parts of the year. But it's still decently profitable, and it's still growing at a pretty decent rate given everything that's going on. It's certainly going to face headwinds, and it won't experience the same growth rates, nowhere near like it did in the past. One of the other problems is how the capital gets allocated. So you've got these tremendous e-commerce platforms that generate a ton of EBIT. That money is either left on the balance sheet, so they have a tremendous amount of cash on the balance sheet, which just stays there earning nothing. The cash that they do invest, they're investing it into business lines with much worse return dynamics than their existing digital infrastructure. They're not really harvesting any of the pricing power that they have on their existing digital infrastructure, and they may be stopped from doing so permanently. A lot of these business practices that they were pursuing pre the 2020 and 2021 controversies are no bueno anymore as far as the government's concerned. And the nature of their offering is that they're an arm for essentially social good and to subsidize consumers. So yeah, like a large portion of this free cash flow just held on the balance sheet. Some of it's invested into loss-making businesses with worse return dynamics than the original business, and quite a lot of assets have been invested into a portfolio of venture and Chinese equities, which who knows. They've made some pretty decent venture investments over the years. It seems to be more of a harebrained, scatterbrained approach rather than the investments that a Tencent would make. And so these declining characteristics have really been the story of why the stock price has gone off a cliff. So if we take this, and I think the price now is below the Yeah, or very close to below the IPO price. And it's a combination of all the factors that we mentioned. So even though you've had growth in earnings, etc., there's serious questions about margin profile of this company over time. Probably, all things being equal, these gross margins are half of where they were, even though the volume of business that they're doing is larger. Their cut of Chinese e-commerce is lower, even though the overall market is much bigger than when they started. And ultimately, there's a question of how much capital can be returned to the shareholders. They have done some limited share repurchases in the last 12 to 6 months. But basically, stock-based comp has massively outpaced any of the repurchases. So, you're kind of swimming against the tide on every factor, pretty much, aside from revenue growth. And eventually in time, the returns to capital are the returns that capital get. And if that cash isn't going to be returned to you in the form of share repurchases or dividends, you've got to be pretty sure that the cash is being returned at very decent rates within the business, and that's an open question at this point. The decent cases to be made, and it was one of the cases that I made at the time when I was investing in this, is that large portion of this business's value would be in the cloud. And if that business could get to sufficient scale, there's no doubt that the cloud part of the business could be tremendously valuable. But it's got serious insurmountable barriers to the kind of scale it needs to get to flex the operating leverage that the other hyperscalers flex. So that's pretty much a walkthrough. Those are all the red flags that you want to look out for. A good learning experience for me. And yeah, I mean, if you see any of those things, it's not good, and basically the stock price will follow those fundamentals over time. Thanks.